Fees are an investor's worst nightmare, and that's because fees can eat up to 2/3 of an investor's potential returns throughout their lifetime. So you as an investor only walk out with 1/3 of the money that you could potentially get, and it is all lost to unnecessary fees. This video is going to tell you what these fees are, where to find them, and most importantly, how to avoid them at all costs. And stick around to the end of this video. I'm going to give you an in-depth example to show you just how damaging fees can be for your investment portfolio. So with that being said, let's get into today's video. The fees I want to highlight today are mostly surrounding mutual fund fees, because mutual fund fees are often the most excessive while also being the easiest to avoid and eliminate completely. So what is a mutual fund? A mutual fund is a fund in which investors pool together their money and hand over the decision making to a financial expert who picks which stocks to buy and sell, and ultimately the goal is for this expert to be able to beat the financial gains of the stock market for that year. While it is possible for people to beat the stock market, and it has been done before, it is rarely done consistently over long periods of time. For his services and knowledge, this financial expert charges a fee. This fee handles administration, management, even marketing costs, which I think is a bit ridiculous. The average fee range for mutual funds is between 0.5 to 0.75%, and anything above 1.5% is seen as excessively expensive. One thing that I think is important to highlight is we're talking about fees right now, but imagine if your money is being held in a taxable account. Not only are you paying fees, but also taxes on that money, and on top of that, there are trading commissions. When you buy and sell stocks, you have to pay a commission on those stocks that were bought or sold. And one thing that mutual funds are known for are high portfolio turnover rates. So these financial experts are doing a lot of buying and selling of stocks and trading. So fees, possibly taxes, and trading commissions are all things that you need to worry about that are eating away at your money. And a very big thing to speak on is that these financial experts, they get paid whether they perform or not. This isn't performance based. So if they lose money for you that year, you lost a bunch of money, and then on top of that, they're still getting paid even though they didn't deliver the results that you ultimately wanted, which is very unfair. So this fee that we're talking about is called an expense ratio. And the way to find this is you would go to your brokerage that you bank with online, and you would log in and then go to the search bar and type in the ticker symbol for the fund that you want to look up. Once you find that fund, you can see underneath the fund information that there's going to be something called an expense ratio. This expense ratio will give you a bird's eye view of the amount that you are paying in fees for this actively managed mutual fund. And then from there, you can do the math and see how much that you are paying this financial expert in fees, whether they are delivering or not. Something I do want to speak on though is within these past couple of years and the rise of low-cost index funds, the mutual fund industry hasn't been able to excessively overprice their management fees, because in the past the average was more so around 2%. But because now they have some competition, they have to competitively lower their prices in order to compete with low-cost index funds. With all that being said, now let's get into the detailed example that I promised to truly show you the devastating impact that fees can have on your overall investment returns. Within this example, I rounded numbers for simplicity purposes and to just get the point across, but we're going to make a couple of assumptions. We have two people named Connor and Bonnie. They both want to invest 100K over a 30-year period, and the stock market gives them a generous 8% return annually. The only difference is that Connor pays 0.01% in fees because he invested in a low-cost index fund, and Bonnie, on the other hand, pays 0.75% because she invested in an actively managed mutual fund. So Connor's nest egg over a 30-year period grows to an impressive $1,002,000. And what he pays in fees during that time is $4,200. Bonnie, on the other hand, her nest egg grows to $816,000, which is still impressive, but the amount she pays in fees, this is the key difference here, is $190K. We are talking about a $186,000 difference based on fees alone. There are no differences between a actively managed mutual fund and a low-cost index fund, aside from the fact that one has a person doing all the trading behind them, and then the index fund mirrors the stock market. Isn't that crazy? Seeing these numbers put on paper, what fees can do to your overall investment portfolio is just crazy. $186,000 difference. And remember, before I was saying, some of these funds that are actively managed can go up to 1.5%. So if we're within the average range that we had talked about earlier in this video, imagine what this would look like at higher fee rates. And there you have it, the destructive power of fees and what they could do to your money in the long run. I really hope that diagram was able to show you firsthand what this can truly do to your investment portfolio after a long period of time. And I made this video because I wanted investors to be empowered with the knowledge to make the best financial decisions for their future and not be manipulated to doing what's best for the brokerage. You put up 100% of the capital, take 100% of the risk, and could potentially be walking out with only 1/3 of your money. For me, that's just plain wrong, and I don't want anyone to get scammed by something like that. And that's why I made this video today, so you can make the right decision for your financial future. That's all I have for you today, guys. I hope you got a lot of value from this video and can see truly what fees do to your money over the long run. I know a lot of you out there work really hard for your money, and I just don't want to see anyone taken advantage of, and I hope this video is able to make you move forward with a lot more clarity and certainty with your finances. Stay tuned for the next one, because I will definitely be coming at you with more financial education and literacy videos. But until then, I will see you next time.